The market taking few prisoners today. Investors in small caps hurt again. They tumbled more than 2%. Crude oil, a bear market. Crude oil down over 5%. And the 10-year yield at its lowest level since October of 2017. But it is also important to remember the S&P 500 is still higher than it was just 1 month ago. The question with all this information and numbers, Guy Adami, what do we do now?
We say welcome. We say welcome.
That's what I said. We do. We say welcome. You're a handsome man, by the way.
I know.
Anybody mention that to you?
Thank you. Every
so
day.
what do you do now? Listen, I still think.
He looks in the mirror and says, Brian, you're a handsome man.
And you're a good man. Yes.
So the December 24th low in the S&P, the recent high in the S&P, 2950. I've said this, I'll say it again. I think a 50% correction of that move is still in order. And that gets us to 2650 thereabouts in the S&P, which give or take is about 170 handles from where we are. That sounds catastrophic. I don't think it is. I actually think it would be rather constructive. I don't think the VIX is properly high enough to represent what some of the headwinds are out there. And I still think there's probably another 7 or 8% to the downside, which gets us right into the sweet spot for a rally.
We talk all the time about essentially the debt markets being smarter than the equity markets, with all due respect to the equity folks, and let's not heap too much praise on those good-looking fixed income folks. But the bottom line here is look at what's going on in the bond market. We ticked down to 229 on 10-year yields. We're back to essentially, it was about 2 years ago, 2.5 years ago. Ultimately, I think the most important point are those flash PMIs for May for the U.S. economy, which printed 3-year lows on services and manufacturing PMIs. Those are leading indicators. Those are giving you a snapshot of just how much CEOs are pulling back. Look, I think the impact mathematically of the trade war on the U.S. GDP right now is very, very small. The big issue is absolutely the impact on CEOs and on confidence. And you saw that in those numbers, and that caved yields in the bond market.
Don't you think they're going to have to be forced, though? My opinion is they're going to have to be forced to have workarounds. They're going to have to be forced to figure stuff out.
Who's they? What do you mean they?
CEOs.
Okay.
So pick it up on what Tim said. Just follow us. So now if the CEOs do those workarounds or they figure out how to source from different areas, that's a good thing. No?
They've always been able to do that. I think, let's go micro a little bit in the market. First off, Karen, though, and again, to your point, Tim, on bond yields, if you watch technically today, the intraday tick, as soon as we broke 2.3, we turned around. Bond yields started to move back higher, and stocks immediately turned around. Karen, is the bond market right now ultimately in charge of the equity market?
I don't know if the bond market's in charge of the equity market. I think, this trade war, if the PMI data is right, and it's not just, we had been sort of overbuilding inventory prior to what could have, worsening trade wars. If that's maybe the Fed is more in play than we have thought, right? So I got to think that the chance now of a Fed cut is higher. A Fed cut, right, is going up. That would be good for the equity markets. I don't know if that means the bond markets are in front of the equity markets. I do think, though, Tim is right. When credit starts to trade really terribly, and it hasn't yet. In the end of December, we saw credit markets really just cave and get really illiquid and wide. We're not seeing that yet, but I think that might be.
I think you do have a shot, and I don't want to overstate this, where Brexit became just a tagline where most people that know it understand it or understand the options throughout Brexit, but they're not overwhelmingly concerned anymore as we were the first day of Brexit. I think we're getting there with trade, where people understand it, they figure it out. Yes, it's impactful. Yes, it's a lot more impactful than Brexit. But I think people are saying now, you know what? Ring me when we figure this out. Let's do the workarounds, and then we'll see where we land.
There's two ways to look at this market, Guy. Number one is, yes, we've been down 5 weeks in a row in the Dow, first time in 8 years. Things are looking wobbly. The other side is S&P 500, that's still up 13% this year, not including dividends. Overall, still pretty good. The market has room to drop, does it not?
I think it does, absolutely. I mean, I hear what everybody's saying, and I understand that if the Fed is in play, to Karen's point, that should theoretically be bullish. I'm not certain it will be this time, and that's what makes markets, in my opinion. With that said, to your point, I think the complacency out there is at epic proportions. I don't think people believe the market can go lower for all the reasons we talked about, which is why I think the market's going lower. You look at some of these companies reported, they weren't gangbuster earnings. They were okay in an interesting backdrop. And I think this China thing gets worse before it gets better. And I'll say again, and I've said this for a while, I think we're further away from a deal now with the Chinese than we were 15 months ago.
The problem here is you're now starting to see commodities cave too. So the knock-on effect actually, and also then high beta EM currencies are starting to blow out. So you are seeing, I know Karen talked about it, we haven't seen the debt blow out yet. There's this triple B threat, which is very, very important. I agree with everything we're saying here in terms of complacency on the equity side. Look, just because he defended 2811 on the S&P, which was very important today, doesn't mean that if you look at equity markets, they're completely missing that the leading indicators of the equity markets, whether it's semis, look at FedEx. I mean, FedEx tells you something awful. And I know FedEx has had a couple of their own operational issues, but the bottom line is I think it's one of the best run companies in the world. That doesn't feel too good, and I think that is telling us.
But if we are worried about the overall economy slowing down, there are quivers or arrows in the quiver of China and us as well. China's got trillions in currency reserves. They're already beginning to stimulate. To your point, retailers are now going to be able to adjust. If they think it's going to go on for a long time, they can make the adjustments they need to. We can cut rates. There's ammunition out there.
There is, but let me ask you this. Will the market give them a pass while they say this quarter is going to be bad because our costs are going to be out of line because we're, trying to change our supply chain and that will take some time and so we're going to miss? I think stocks will trade down.
But does the Fed, though, to your point where you started off, does the Fed trump all of those other worries with easier rates? I mean, it's very hard not to be a buyer of the equity market where rates are right now. But it's very hard.
It's interesting because, we've had people all over the place telling you when the Fed stops cutting, it's actually a great time for markets. We've also heard, and they've both been right, when the Fed stops hiking, it's a great time for equities. When the Fed stops hiking and actually starts cutting, it's actually a great time for equities. It's not a great time for equities. I mean, you can make an argument, and I'll say this one more time, a growth scare is much worse than an inflation scare. I'd love to see the Fed hiking right now in an environment where it was deserved.
But
maybe that's not.
I want to go back to Karen. You made a very important point, and I'd like to hear everybody's thoughts on this. If Big Box Store comes out and says, we're going to miss our numbers for the next 2 or 3 quarters because we're permanently changing our supply chain, be patient, will the market give them a pass?
Not
now.
Right away. No, it's not right now. Right. I mean, we're not in earnings season yet. I think we'll start to see that in July. And right now, it's just macro things that are making the market trade, not very much fundamental earnings.
Permanently changing the supply chain is such a fundamental, that is such a huge move that I agree with. I think they would be punished for that. They can't do it. I don't think they can.
I mean, to act like there's a workaround, I don't think you're oversimplifying this, Steve, but I think at this point, it's crazy to think we can just decide we're not going to deal with China on a global basis.